Okay. Over to you, Michael Bergio.
Welcome to Morning Minutes with myself, Michael Bergio, Mark Novak, and Adrian Lee. And this morning we're going to be talking about freezing money, freezing loans. One, it's not free money; it's freezing. I think a lot of people are wanting to hear what they want to hear, and bad credit, how that can potentially affect freezing mortgages or any of the stimulus out there. And also, will freezing your loan count as bad credit? We've got Adrian. Adrian, do you want to tell us a bit about yourself and what you do, and why the millions of viewers should listen to what your view is?
Can I say before you introduce yourself, Adrian, a lot of the guys that are watching the show know us. I do have to say, Adrian is one of the smartest guys in the money business that I know. He's super smart and he's got a massive, massive heart, a great guy and a great family guy. And it's an honor to have you here today. Thank you, buddy. Over to you.
Thanks, Marky. So I guess a bit of background on us is I'm the MD of a company called Catalyst. So we do a few things within the business, starting from development financing to debt funding. We've also got a wealth management and investment management side to the business. But I think what was sort of more relevant for this was our residential home loan business. So we started that about six or 7 years ago now. Our loan book's about $1 billion, so we're pretty good in that space.
And I love how you can draw on all different parts of the market, Adrian. That any talking advice or whatever you're giving today, you're actually not just drawing from one segment or one asset class. You're drawing from all of them. I love that.
Yeah, that's a really broad approach. Like, you got the residential, then you got the wealth management and the commercial. It's a very holistic view, and probably it'll be really good to share those trends that you're seeing from your SMEs, from your mum and dad investors to your mum and dad homeowners, and then also some of the shifts maybe some of the bigger businesses are doing, because sometimes that will set the trend downwards in the sort of scale. So where do you want to start? Mark, what do you want to start with? Or Adrian, what are you seeing out there?
Talk to us.
I mean, look, I think, this is, like I said, this is probably more relevant for your residential guys for the moment. But if we just sort of, go back to what exactly is a repayment freeze and how the lenders, how they're approaching this, I think, look, the important thing to sort of recognise is that, the way that this really works is that the government comes out and, announces X, Y, Z, and the banks are in the background sort of scrambling on how to put this all together. So on the ground, it is extremely messy. If you are a borrower who's tried to contact your bank in regards to a repayment freeze, the standard hold times are hours. A lot of them are diverting you to online forms or emails, and they're taking another sort of 7 to 10 days after that. So it's not a smooth and linear, super transparent process. But in general, the idea is that the banks are offering their clients between 3 to 6 months. So some lenders are happy to capitalise your 6 months of repayments up front. Some lenders want to let it run for 3 months and then have another assessment after that to take you to a total of 6 months. Some lenders are asking for some kind of evidence in regards to income changes, but most lenders are just granting these willy-nilly. So I think, back to your point, Michael, the really important thing for borrowers to remember when considering some kind of repayment freeze, particularly if it's, really more an opportunistic approach. So in other words, well, it's available to me, why wouldn't I do it? So again, lenders are all approaching this differently, but essentially what they're doing is your 6 months worth of repayments, whether it was interest only or principal and interest over that 6 month period, is effectively capitalized onto your loan. So as a really quick example, if your repayments were... So the example is if your repayments were $5,000 a month, and you didn't pay that for 6 months, at the end of that 6 month period, your loan will be $30,000 higher than what it was had you have maintained those repayments.
Wow.
So, correct. Now, there's a few nuances in that as well. So I suppose, for a lot of borrowers, so, arguably if you're an investor and your home loan's on interest only, which, from a tax efficiency point of view is probably the most common approach. And let's just say that you were to capitalize your interest repayments, but the amount that loan had capitalized was sitting in your offset account, then over that period of time, you actually wouldn't see an interest increase because your interest-bearing balance is the difference between your offset account and your loan account. So for argument's sake, as opposed to paying $2,000 worth of interest, because you froze your repayment, your offset account balance was $2,000 a month higher over that period and continued to be over the next 6 months, then you actually wouldn't pay more interest over that period, provided that you then equalize it in 6 months' time. So that's a real roundabout way of saying that this will affect different people. Well, where do you want me to start from? So, Marky, what happens is when you buy a house, you receive a loan.
We got two bananas.
It's called a home loan.
I give you one banana, and then you give me the banana back. And okay, so can you go do that again slowly? So the $5,000 a month.
Yeah. So maybe an easy way to break this down is there's two ways to look at this. So number one is that your home loan repayment essentially it's not an interest-free loan for 6 months. They're just tacking that interest onto the back end of your loan.
And because you're not paying down the debt for that 6 months, it's actually going to be more interest on top. It's probably the simple way to think about it.
Exactly right. Correct. And so that's right. Although having said that, if you're not making your interest repayment, but you're not blowing it on toilet paper, so your offset account balance is actually higher throughout that freeze period, then that offsets the interest between the two.
But not many people would have an offset, Adrian, already set up on their loans.
Yeah, look, an offset account, to be honest, Marky, over the past couple of years, it's pretty hard to get a variable rate loan that doesn't have an offset account. It's a pretty standard feature.
Okay.
And, I think you're right in the sense that a lot of people don't use that functionality properly. But if you have a variable rate loan, you have every chance that you do have an offset account, whether it's utilized or not.
Yeah.
And, having that balance increase over the term will actually offset the interest capitalization offset.
Do you think it would be better to get a small personal loan or a credit card to pay your mortgage rather than freezing it because of the amount it accumulates?
No. So, look, even on a capitalization basis, the rate on a home loan is still, probably 3 or 4 times lower than that of an unsecured personal loan. So whether or not you take funding from elsewhere to cover that gap or you stop your repayments, if you actually do require that mechanism, it's actually a pretty cost-effective way to do it.
Okay.
Because in terms of the sort of risk to cost scale, home loans sort of sit right at the bottom.
Yeah, Adrian, sorry guys, I would as a consumer, freezing my mortgage, that sounds like to me an absolute party. I would love to do that, and I can't see why most Australians, irrelevant to their position, wouldn't take that up, right? But if they do that, they're not bad people. Good on them. Have a hack, go for it. But it may be a good idea to take that mortgage money and do what you're suggesting of putting it into an offset or putting it aside or just not to live in. Because at the moment it's pretty hard to spend money because you're at home all the time. So the odds are they're going to have that. They're going to have that mortgage money there and spare, and it could be a great advantage for an Australian to save that mortgage and more and slam dunk it into their mortgage at the end of the 6-month period. Keep their powder dry, keep it there in your account or in your offset or in your savings, and then slam dunk it. Because the bottom line is we're not spending as much as we were spending in February.
So would you advise everyone to do that, Adrian? I know Bill's just said, so put your monthly payments into your offset every month to cancel the capitalization. Therefore, the bank up the money over 6 months and then you free up cash flow. So do you reckon that's a good option?
Freeing up cash flow, that's a good word. Yeah.
So there.
Yeah. So I think, look, we've got to be really clear about this, guys. So for a lot of our clients are thinking, well, my income actually hasn't been impacted yet. So either, I run a business where my revenue is recurring or it's been delayed. And, the fact that there's been a slowdown in the real economy quite quickly hasn't yet impacted my business, but I'm uncertain about future cash flow. Likewise, you might be an employee and at the moment, management are telling me that everything's fine, but I can see things slowing down and I'm, nervous about my future cash flow. So in those circumstances, it may make sense to freeze your repayments, even if it's not an immediate need, because at least you have that optionality, provided that you're smart with your money and you're saving it into an offset account to offset the interest capitalization effect. So that's definitely a valid strategy. My only caution with that is this. So APRA has been very clear about informing the banks that loans with frozen repayments are not to be considered in default. Now, that I think a lot of people have taken that to say, well, there are no material credit impacts to freezing your home loan repayments. And it's actually two different things. So when APRA tells a bank that frozen repayments are not to be treated as default, it's effectively telling the bank that you don't need to provision additional capital to that loan. So in simple terms, if you're a bank, you've given a loan to Adrian. Adrian's not paying his home loan. He's 30 or 60 or 90 days in arrears. That lender will then need to take capital, which is expensive for the bank, and set it against that loan in case Adrian really goes and blows this shit up. So what APRA is saying is you're going to have a lot of people asking for freezers. So a lot of people aren't going to be making their repayments, but you don't need to provision capital to that loan. So in terms of the regulatory restrictions, we're not going to look at it as though these loans are in arrears. Now, that is really no guarantee that on refinancing or down the track when you look at buying another property, or whatever happens when we come out the other side of this, that another bank isn't going to say you haven't made your repayments for 6 months. We want to understand why.
That's true, and it really shows that you're vulnerable as well, and your risk, regardless of if. I just think, obviously, if you have to, you have to. But if you don't, you just don't. You're right. You don't know how they're going to interpret this down the track. Like, yes, right now everyone's like, okay, it's due to COVID, it's normal, but you don't know what a bank's going to think in the back of their mind, that they go, well, there's a lot of clients who weren't affected and still made payments. Maybe they had savings. You didn't. So I think it's going to be hard for people not to be, I don't know.
Look, I think you're right. I think, look, equally speaking, there's every chance that a bank might look at it and say, well, look, it was an option we gave to customers. You took it up. We're going to look through the cycle. Yeah. The problem is that we're not going to know how a bank interprets what happens here for at least 6 months. Because, I know for a fact that if you have your loan repayments frozen now and that you're trying to refinance, another bank doesn't want to take on that problem. So that, at the moment, it is a problem. If you do want to buy something in the next 6 months and you've got frozen repayments, you'll have to be prepared to explain that. So, I mean, this whole question about, well, what happens in 6 months' time when, loans are running back to normal on scheduled repayments, borrowers might be looking at purchasing or refinancing again. How is that interpreted? The reality is that we're not going to know for 6 months.
Yeah.
So that is a risk.
The reality is it's not really a good answer. It's not really a bad answer by the sounds of it, but it's not a good answer either to turn around and say, in 4 months' time, I want a loan, or 6 months' time, I want a loan. And they're saying, sure, but why did you have your loan? Or why did you freeze your pay? It's not really good, is it? It's not really.
Bill made a comment then going, yeah, if you actually are freezing it for strategy, for cash flow, but you're still paying, then you can always go back and say, I continued to pay. It was just a mechanism I used and for cash
That's
flow.
Good call.
That's a good point. All right, so move. Okay, now what other? I know there's the $250,000 loan out there that the government announced, but my understanding is there's no real product from banks yet for people to access that. So, is your understanding of that the same? The guaranteed loan for $250,000. Is there still no real product from a bank to offer that to small businesses as of yet? And I'm sure we don't know what credit policy they're going to be looking at that either, because it's unsecured. Is that still the case?
There's actually been a lot of clarity on that in the last couple of days. So literally, I think Wednesday, Thursday, Friday last week was when the bank started to kind of really communicate where they're at with this. So, we spoke to senior management inside of CBA, on the Monday after this was announced, saying, yeah, we've got $10 billion in our accounts and we've got no idea how to deploy it. And I think every bank was in the same position. I think the way that it's starting to shape up now is that, so number one, this facility is only 50% backed by the government. So if you were to borrow the maximum 250, the bank's still up for 125 in terms of their liability on bad debts or their exposure to bad debts. So they are applying credit policy to this. So the two things that seem pretty clear now are that the product parameters, they all look very similar. The rates are around 4.5%. Most lenders have no establishment fees, no early repayment fees. Again, it's not an interest-free loan for 6 months because your payment and your interest is capitalized over a 3-year term. So what it means is that if you were to borrow 250,000, you don't make repayments for 6 months. You then need to repay the 250,000 plus the repayments that you did make for 6 months over the next 2.5 years. So for us, that's considered a very aggressive amortization profile.
That's super aggressive because
so
people aren't used to lending on those 3-year terms. People are used to lending that amount of money on a 20 or 30 or 40-year term, 20 or 30-year term.
Yeah.
So that's aggressive.
Just to point out there, you said
it is, yeah.
That's low. Isn't normally it's like 10 or 12% for an unsecured loan or a business loan? You said 4.5. Surely that's low.
It is low. I mean, look, part of the other measures that haven't got as much sort of press was that a lot of the small business rates have come back quite a bit. So a lot of the banks have reduced their rates by 200 basis points particularly for small business stuff. Yeah. So look, it is low. But having said that, the other thing that the banks have come out with is, number one, it seems like to access that loan, you need to only speak to your primary bank. So in other words, if NAB holds your primary accounts, they have your home loan, they have your credit cards, it'll be NAB that writes or reviews that facility for you.
So you can't.
No. So most of the banks are saying, listen, we're only going to offer this to our individual clients. And the reason being is that they've got some sort of relationship or oversight on the borrower. And they're probably, if you've got home lending with them, you've got leases with them, they know who you are and how you behave. So this is not really just let's open up and everybody take 250 for no reason. Mm-hmm. The other thing too is that at least CBA is saying, look, we're prepared to look through the cycle, which essentially means that we're not going to look at what your business turnover profitability looks like, maybe for the first quarter of 2020. But previous to that, so when we look at your financials up until the end of 2019, if you would not have qualified for a $250,000 overdraft based on our regular credit policy, you will not qualify for this loan. So the only point of leniency in that credit policy is that we'll ignore what happened in March because March is March.
Yeah.
But all other rules apply. So you sort of need to question, well, how many small businesses, hospitality or tourism or the industries that have been really affected would have qualified for $250,000 of unsecured overdraft credit? And in my experience, I'd say, look, it'd probably be less than 10%. Yeah. Most businesses wouldn't qualify for that.
Because that's paying it back in 3 years. That's heavy.
It is heavy. And I think the problem, my biggest concern with this is that I think what will happen is you'll have businesses that take up this 250K facility. In 6 months' time, it'll help them trade through whatever they need to get through. And then during this period of heavy amortization, they're going to want to refinance back into a longer term, more sort of cash flow friendly product. Now, at that point that you want to refinance out of this facility, if you've frozen your loan repayments for 6 months, if your financials for 2020 don't look great, and I don't know whose financials will look great during this period, then what are your chances of refinancing out of that facility onto a longer term loan with more cash flow friendly repayments after the term? And I'd say that would have to be pretty slim as well.
And it won't be backed by the government refinancing. It's only the initial.
That's $8,000 a month.
Yeah.
Yeah, 7.5.
It's big. Bill's asked question here, Bill's like, how do you apply for the business loan and what are the requirements? Do you have to go through the whole? So that basically you apply through your current main bank and they will assess it like a normal loan.
All right, the big topic I want to talk about, boys, the big topic I want to talk about when we finish this topic is the credit rating. So let's finish up on this topic, the 250 topic.
Yeah. So just to answer Bill's question real sort of quickly, you apply directly through your broker. So, if we've got access to all of the lenders who can help you prepare that paperwork. It's not yet clear whether brokers are being remunerated for this deal. But my opinion on that is if your broker is half good at what he does, he'll want to help you throughout this period, whether he's getting paid or not. But they're in the best position to get the paperwork together, submit it through, get to an approval. So that's your best starting point.
Okay. So Mark, credit rating, what do you want to talk about? Credit.
Well, so if I trash my credit score in the next 6 months, it's going to be ignored when I go to get a loan in the future. That's the myth. That's the sounds good. Is this true?
Say that again.
So look, again,
all good. If you heard it, Adrian, that's all good.
Yeah, no, I did. So there's look. The other point to this too is that the credit reporting agencies have confirmed that the repayment holidays will not be treated as being in arrears. So if you've ever seen a comprehensive credit report these days, it essentially lists all of your liabilities with boxes for each month. And there's a number in there, whether it was a repayment that was made on time, was it not made on time? If it wasn't made on time, was it made more than 30 days in arrears? So the reporting agencies have confirmed that these reports will not show that they've been in arrears, but they will show that that repayment wasn't made because it wasn't. So if you look at the scale of number 1 means you made a repayment on time and number 3 means you're in arrears, your credit report will be showing a lot of number 2s for the next 6 months when you haven't repaid your loans. Now, again, it's not a default. So technically, I think that, if I was to go and have an argument with a credit officer in a bank to say, have these repayments been made on time? There's definitely an argument because I didn't just not, I came to an arrangement with my bank. So, like I said, jury's out. We're not really sure how that's going to be interpreted. I wouldn't be surprised if at least a few lenders said, look, if you had troubles in the last 6 months and couldn't make your repayments, we're not taking that liability on. Now, maybe they might not say that to you, but like anything else, the way that it gets reported back is a whole bunch of irrelevant questions. So when you submit a loan to your bank and they start thinking, well, can you tell me the middle names of your children and your blood type and their blood type and what, to them, it's sort of like, we don't want to write this loan, but we make the process difficult by asking a million questions.
Yep.
I wouldn't be surprised if it's sort of dealt with in that manner, as opposed to any bank coming out and saying, you took a repayment freeze, we're not writing you because of the risk around PR.
Yeah, it's one of those, as Bill says, uncharted waters, and you think they would probably pick the higher road for this period. But I wanted to, have you had any, I've heard that a couple of banks, basically any pre-approvals, and they're really going to be looking at your job role. So anyone in hospitality, anyone in hotels, I've heard from one bank, basically they said go through all applications, anyone in those industries, call to confirm they've got a job because we're basically tearing up the pre-approval. Have you heard along those lines from any particular banks? You don't have to name them, but basically...
Yeah, I mean, look, it's definitely the case. So, we need to keep in mind that, okay, so banks are being friendly from the perspective of freezing your repayments. In terms of writing new loans onto their books now, they are very concerned about the performance of their loans within their portfolio. They don't want to write bad deals on their books at the minute. And so naturally, they're changing their credit policy to ensure that they're essentially not writing problem deals. Everybody's worried about the fact that property, market value decline. And if I write a deal at 80% today and somebody goes and capitalizes 6 months of repayments, I'm already at 82% LVR. If the market comes back by 10 or 15%, they're starting to look a little bit hairy. So lenders are definitely sort of tightening those screws, and they're doing it in different ways. So one lender, at the moment, calling employers really was a thing of the past. So, 10 years ago when you were at a home loan, it was really normal for someone at the bank to call your employer, ask if you're still employed, ask about salary. I mean, that sort of thing just doesn't happen these days. One lender has gone back to doing that because they've worked out that, if you get paid monthly and you received a pay slip in the beginning of March, your whole world might have changed by now. So you might have been stood down, you might be on part-time, you might be on half salary. These are all pretty common revenues at the moment. So they're calling the lender they're calling the employer to understand what's happening there. We have other lenders who have sent out communications to say, look, if you have had a pre-approval in the last 6 months, they are no longer valid in the sense that we will now need to ask you additional questions, particularly around COVID and your response and how it's been impacting you. Which essentially means reassessment. So, a lot of the clients that we're helping at the moment, I suppose that, if you're not in a position to buy, you're just not buying. But if you had purchased a property off the plan and now this has come up at a time that maybe wasn't great, but you're locked into a contract, but I had a pre-approval 6 months ago, so I'm just, waiting for evaluation. We're doing a lot of work for those kind of clients to ensure that they understand that the credit positions for the lenders has changed. So we're going through a reassessment process. If it turns out there has been some falls in income, we're working with those borrowers now to work out how we can restructure these contracts. Maybe they can bring somebody else on.
I can just picture that now. Like, Mark, if this happened to you, like we had couple hundred units all selling off the plan, that would have been horrific. That you've had your finance all good for, say it's a waiting period of 2 years. Now you come to this quarter settling, the whole game has changed on you. Wow. Wow. That would be tough.
Yeah. So, I mean, that's probably, for us, that's priority number one.
Okay. All right. So to sum up, and our takeouts from today are freezing of loans, go for gold.
And still try to freeze, but still try and make the payments so your interest isn't high at the end. If you can't make the payments, then freeze, but you will be paying more at the long run.
And the reason why is we're clear that the banks are friendly towards it up front. The government likes it up front. The consumers are lapping it up front. But where we're not clear is when we're looking at the rear vision mirror back 12 months or 6 months, what is the bank going to say when they look at that? Are they going to say, hey, are they going to treat you any different to someone who didn't defer the loans is the question. And then the other takeout is the credit rating freezes that are happening at the moment. Adrian, I just didn't realise how detailed these were. I didn't realise that there was ones and twos or whatever you call it. So every single repayment you make, if it's not made on time, you get a number put against you. If it's not made within 30 days, you get a different number put against you for every single mortgage repayment.
And application you've done as well. They're very detailed. So the takeout there is these will be just classified as a non-payment, not a default. That's the big takeout with your credit score and your credit report. If you're freezing, that's what we know for certain. What we don't know is, in 12 months' time, will that be a red flag because you did something? But as Bill pointed out, if you're freezing but still making the payments, then you can obviously justify that as well. Refinancing would be a big one at the moment if you can, because rates are, don't you reckon, Adrian, anyone who basically bought 2 years or longer ago and hasn't refinanced are probably on a much higher rate than what's out there? Are you still seeing people on 4, 5, 6, 7% interest out there that may have just been busy and haven't paid attention?
Yeah, so I think, Mike, the big thing is, we've had probably, 6 rate decreases over the past sort of 12-month period. So there's been a lot of changes, and I suppose what happens is every time there's a rate movement, a bank makes a decision on how much of that they're going to keep, and it sort of filters down. So once you have a lot of these changes and you're still in the same outdated product, there can be a pretty big spread between what's market and what your current loan is. And so, look, for a lot of our clients who are thinking, well, look, I'm actually not in a position where I need a repayment freeze, but I wouldn't mind tightening things up at the minute. I actually think it's a good time to look at refinancing that loan so that you ensure it remains competitive regardless of what happens to your credit in the future. I think that is probably a better approach if you are being opportunistic about repayment freezes. You might be able to get a better outcome just by ensuring that you're at a better product.
Yeah. And Adrian, is it true that they call you Batman?
I've only heard that once.
and also, the two people that are on my screen above me, do you know the names of those two ladies?
I do. So I was saying to you earlier, I know one of them's Elsa and the other one's Anna. I just don't know which is which.
Yeah.
I've got a 3-year-old daughter, so I know, broadly, but I don't know which one's which.
Is there anything that you don't know?
Yeah, I wouldn't know how to sell a property. Or buy one, for that matter.
Just to wrap up, Adrian, anything else that you're seeing out there, or anything that people are doing that you, doing with money or looking to buy at the moment because money is cheaper? Is there any just a general advice out there?
Oh, look, I was actually going to ask you guys, I think you know better than me. So my view is, we've got a lot of clients who are sitting on cash and they're thinking that this is when you make your money. A lot of our bigger clients made a lot of wealth throughout the back end of the GFC. So they're sort of licking their lips thinking this is great if you've got enough dry powder. And so my sort of view was, well, I suppose you need to look at these repayment freezes as almost like a deferral of the real problem. So at the moment, it's actually impossible to default on your home loan because your lender should be giving you a repayment freeze. So for the clients who are thinking, well, let's be a bit opportunistic and look at it, my view was that, well, you really should start to see, the impacts of distressed sales and that sort of thing probably in 6 months' time from now. But like I said, that's not my expertise. So I kind of was more wondering what you're saying and whether now is a good time to buy something, or do you think it'll get better for buyers, as the months progress?
Well, I think at the end of the day, inquiries are down. So regardless of waiting for the distress sales, which may or may not happen, now's phenomenal, because if we were getting just say 10 inquiries, I think a lot of consensus out there, I'm speaking to a lot of agents, is instead of getting 10 inquiries, we're getting 2. So just pure supply v demand, the buyer level has dropped. So I reckon now is a great time, because we were seeing January, February, if you listed a property worth 800, you were guiding 800. The competition was taking it to 900, 920. Now you're probably going to be buying where that level is, because you're not having that huge amount of competition. So I think, in my view, there, and also with commercial, a lot of people, because residential, there's still a lot of people that need to buy because they've sold, or families larger, families smaller. With commercial, a lot of them don't have that. So now, if there was still 20% of buyers out there for a resi, I reckon commercial there's 5%. So now, but there are a lot of people who want to sell. So I think now's a phenomenal time to be looking at that commercial market. I'm saying to clients, if you could buy for 2 million, if it's tenanted, buy something for 1 million and be happy if it's empty for a year or 2, because a lot of the feedback out there is, why would I buy a retail shop when half the businesses can't trade? But that's when you can negotiate a great price and just ride the wave out. So that's my take on that. What about you, Mark?
I think it's probably, if you had it on the radar, snap it up. Would you come onto the radar as due to the times? I don't know, probably, yeah. I think, look, I reckon, and I know we had the chat the other day, market's probably pulled back about 5% in residential, and resi rents are probably pulled back 5 or 10% for the moment. But the sheer fact that money is so cheap and you can lock money in for so long, so cheap, I think it's a wonderful time. So if you've got the ability, I probably would. Yeah.
What's the rates out there at the moment? What can you lock in? 2.5, 2.7 for 3 years, 5 years? What are the best deals out there for a good customer at the moment with a good, just say an A-rated customer? What's the deals they can get out there?
Yeah, so two-year fix looking pretty attractive at 2.19. So the spread between that and the current variable rate is probably 0.6 or 0.7. I'm sort of a bit at a loss as to how these things are calculated, because the RBA's only got 25 points left in the kitty. So how we sort of get 70 points of spread over the next 2 years, I don't know, even if the cash rate goes to 0. So to me, 2.19 seems pretty good. The other advantage of that is if your loan was interest only, but you're taking 0.7 off your rate, there is a good chance that your P&I repayment is now what your interest only repayment was. So maybe it's not a bad time to be just chipping away some principal. So 2.19 is the lowest, I think we've ever been at, ever.
And it's the biggest cost you've got in your home, your mortgage. Right. So I think that's at an all-time low. It's a quarter to a fifth of what it was, 15 years ago. It's good times. So I think people should be really saving. And I know people have lost their jobs, but together with government incentives and the lack of expenditure because you're just at home, it's pretty incredible times to save some money.
I think so. I reckon key things in this marketplace is refinance. But if you've got the one property, you've owned it for 5 years, 10 years, 15 years, you should be pulling out some equity at whatever it is and buying an investment, because if you're getting money at 2.5%, your rental returns are still around there, 3.5%. You're going to be making money for doing nothing. Are you getting many clients like that, Adrian? I own 15 years, or is that one thing you'd be encouraging people to do as a blanket?
Yeah, look, it's always dependent on someone's individual circumstances. So we definitely don't make blanket recommendations to clients across the board. But yeah, I think if you have equity, and like Marky said, if it was your intention to buy an investment property anyway, given that the investment horizon for residential property really should be that 8 to 10 year mark. Is it a bad time to buy? Well, I can't see how it is. I mean, whether or not you're going to pick the exact bottom, I mean, over 10 years, who cares? Property is cheaper today than it was 3 months ago. That's probably the big point.
That's very well said. That's very well said.
All righty.
All right, awesome.
Thank you very much for coming on, Adrian, Mark, as always.
That's all right. Thanks for having me.
No problem. Anyone out there, thanks for the comments, Bill, Amal watching, Michael, everyone there. This will be putting in a podcast format as well and redistributed. So thank you, everyone.
Giddy up.
Thanks guys.
Man.
Bye-bye.
Thanks. Yeah. I hope we helped you today, everyone. Cheers. Bye.
Thank you.